If you had to master one element of technical analysis, support and resistance is among the most important. It's very basic, very easy to understand, but it can make you a lot of money. So let's get into it. Hi, I'm Chris Rowe, the founder and CEO of True Market Insiders. I'm also a 28-year Wall Street veteran at this point, and so I'm not one of these YouTubers that are claiming to understand how the financial markets work. I'm a market analyst, I'm an institutional money manager. I went to Wall Street when I was 17 in 95. And today I'd like to share with you one of the most important and easy to understand technical analysis concepts: support and resistance. Before I go any further, if you're interested in learning more about technical analysis or technical indicators, literally anything at all about the market, please hit those like and subscribe buttons below. The most important one is the subscribe button, because this way I'll be able to give you more stuff like this. Our mission at True Market Insiders is to level the playing field with the suits on Wall Street, like I used to be. And we want to teach you the things that they don't want you to know. And I'm telling you firsthand, I know that they don't want you to know this because I used to work with them. I want you to take control of your financial investments. I've had a wealth of knowledge as a professional money manager, and I want to be an open book for my subscribers. So this is like your own personal Wall Streeter. If you have any other questions, ask us in the comment section below. Often, questions that I'm asked turn into other videos. So if you want to see other videos or articles, just let me know. So on to the topic of this video: support and resistance. One of the most basic fundamental elements of technical analysis is support and resistance. As simple as support and resistance is, it can tell us a lot about the current state of the stock market. So it is critical when determining supply and demand and market psychology. That makes it a great tool in understanding where you should look to buy stock or where you should look to sell stock. If you had to master one element of technical analysis, support and resistance is among the most important. It's very basic, very easy to understand, but it can make you a lot of money. So let's get into it. To put it simply, support and resistance are the two levels where the forces of supply and demand meet. It's where reversals happen in the price chart. It's where the market decides that a stock has become too expensive or too cheap. Support is the level at which demand is strong enough to stop the stock from moving lower and reverse back higher. So they're supporting the price of the stock. They're not letting it fall. So as the price drops and it approaches that support level, which is kind of like a floor, buyers or demand become more inclined to buy. Obviously, the price is going down. It's becoming more attractive. Sellers or supply becomes less willing to sell, especially because those support and resistance level become well known to everybody, and they know that usually buyers come in and overwhelm sellers at that point. So of course they don't want to sell down there. They'd be making a big mistake, especially if they're betting against the price and selling short. When you're looking at a stock's chart, you see support is where the price tends to bottom out. It's also where the price tends to reverse up. So identifying support on chart, very, very easy. You're going to see certain price points have a tendency to be where the stock bounces back. And if you see the stock's price tested once, that indicates where the support level actually is. So if you see a stock declining and then it bounces, it's probably a support level. It's proven to be a support in the past. People like to see at least another support level or another bounce off that same level just to confirm that it is in fact a support level. And when you see it twice, you'll know that is a super strong support level and it can definitely be relied on. But support doesn't always hold. So when I say it can definitely be relied on, it doesn't guarantee that the stock's going to bounce off that level. A break below support level indicates a new willingness to sell or a lack of incentive to buy. So again, there are people that decide that they are all done selling when the support level is reached. But if you have a new revived wave of selling, where you have somebody out there that wants to initiate a short position and they're going to sell so much stock that it overwhelms the buyers and knocks it down, or maybe you have a big stockholder who's been selling and knocking the stock down, and they run right over those buyers that are sitting there trying to hold the stock up. So when a stock breaks new lows, breaks through support levels, it signals that sellers have reduced their expectations and they're willing to sell at even lower prices. In other words, they're very anxious to get out of the stock, or they're very anxious to initiate that bearish position. A bearish position means you want it to go down, okay? It also means that buyers weren't willing to buy until prices declined even lower below support. So those buyers that were there before decided to step out of the way and just let it happen. Once support is broken, another support level will eventually be established at a lower price. And when I talk about short sellers or bearish investors or people that want a stock to go down, sometimes confuses the listeners or the viewers because they're not used to thinking in those terms. They're used to thinking in terms of stocks going up, buy low, sell high. They're not used to thinking of sell high and then buy back lower, but that's something that's done every single day. And it's an important thing to understand about the stock market because that first low that is put in is not there because a bunch of buyers stepped in and they're brave and they said, no way this stock should be down here. I'm going to step in front of this train and I'm just going to buy all the stock they have for sale until I change the supply-demand relationship myself. No, that's not what happens. The first bottom, after a support level is broken and then the stock's in free fall, that first price bottom happens because short sellers, bears, people that were betting on it trading lower, are exiting their position. So when they exit their position, in order to exit their position, they have to buy back the stock that they previously sold. You're probably asking, how can you sell stock without owning it? And it's not important right now. Just know that you can. So they're buying back their big short positions, and that's the first bottom. Nobody's brave enough to go in and just buy stock in a free fall. It's like catching a falling dagger. Now let's turn to resistance. Resistance is the level at which supply or sellers are strong enough to stop an advancing stock dead in its tracks from moving any higher. It's the ceiling. That's the resistance level. So as the price rises and approaches resistance, sellers or supply become more inclined to sell, and buyers or demand become less willing to buy. So they're basically seeing the stock moving higher and higher, and they're saying, you know what, I am not willing to buy anymore. This is the point where the market has rallied before and it can't break through no matter how hard it seems to try. It's where the price tends to top out, and the market resists any higher movement. And it's also where some tricks and fake outs happen, but I'll get to that in a minute. When the price comes to this level, it reverses back down to the downside, okay? Identifying resistance on a chart is the exact opposite of identifying the support level, which is the floor. So you have a floor and you have a ceiling. You'll notice that certain price points have a tendency to be the place where stock fails to go any higher. If you see the stock price test that once, it indicates that that is where the resistance level is. When you see it twice, you know that's a strong resistance level, and you want to be very careful about buying anywhere near that resistance level. One thing that you should know, and a lot of people sleep on this, they don't know this, they were never taught this. I'm going to tell you a little trick. You'll be one of your only friends that knows it. When you have a resistance level on a chart, and you're looking at that stock and it's trading higher and it's moving towards that resistance level, most people will just think, resistance level. That's where the price will run into resistance, and that's it, right? But here's a trick. That resistance level is a place where the stock actually kind of wants to go. It kind of wants to gravitate towards. So if the stock's at 15, it's going higher, resistance level is at 20, know that that stock probably wants to get up to that resistance level. And if you see the stock trading higher on increasing volume, it's probably going to get at least to that resistance level, and then we're going to decide if it wants to break through or not. That's another story, but a little bit of a side tip. But resistance doesn't always hold. So a break above resistance signals that bulls have won over the bears. The bulls have won that battle. It shows a new willingness to buy or a lack of incentive to sell. But it's an achievement, and that's the point that you really want to understand. It's an achievement. So when you see a stock break above a resistance level, it's an achievement. It says something about the stock, and the next stop is probably the next resistance level, which is much, much higher. So you want to be careful. You don't want to try to buy stocks hoping that they break out of that resistance level. Now, if you buy a stock hoping that it's going to break a resistance level, I hope you bought that stock much lower in anticipation of the stock at least trying to gravitate towards the resistance level. And then if it breaks, that's great. It'll break the resistance level. But don't wait till the stock gets up to a resistance level and then buy it, hoping it breaks and overcomes the past resistance levels. When resistance breaks and creates new highs, it indicates that buyers increase their expectations and they're willing to buy at even higher prices. Think about it. They know that that was a place where sellers usually sell, yet they still bought, right? They know that this is a place where the stock usually reverses lower, but they still bought. And not only did they buy, but they bought so much that they actually eliminated that resistance level. They could have waited. They could have backed off and waited for prices to go lower so that they can buy at a lower price, right? They're buyers. But they didn't do that. So what does that tell you? That tells you that they're pretty much buying almost recklessly with little regard to price and with little care that they could have bought it cheaper. They're saying, I have no time to wait. I'm going to buy it right now. I don't care. I'm not going to wait for it to go lower. I've got to get in now. And that's what you have to know. These people are risking their jobs. They're risking their income, yet they're going to go ahead and charge forward. they're not going to wait to try to buy it cheaper. So think about that mentality. What does that investor know, right? And those short sellers, they're used to selling at that price and seeing it go lower, but they actually lost the battle. They turned around and became buyers instead. So it's a very big achievement when a stock breaks above a resistance level. And just as a side note, I have another video that you should watch about the New York Stock Exchange BPI, Bullish Percent Index. That is actually an indicator that tells you the percentage of stocks in any group that are making that achievement. So if you see a whole bunch of stocks in the semiconductor sector achieving that breakthrough of the resistance level at the same time, that sector is going to go higher. All right, so let's bring it back. When resistance is broken, another resistance level is going to be established at a higher price. So when resistance is broken and they make that achievement, look to the next resistance level that's already a historic resistance level. And if that doesn't exist, like if you're breaking new highs, then you can use other things like Fibonacci extensions to find the next level of resistance. Even though it's never been established, Fibonacci extensions are the way to go, or Fibonacci fans. It's easy to recognize support and resistance. And there's a lot of kind of rabbit holes that we can dive down with BPI and Fibonacci and all that stuff. Don't worry, I'll make videos on all these things. But how does this help us? As I said earlier, support and resistance is critical to understanding where to buy a stock or ETF or where you should sell, even a mutual fund. It gives us a safe price to buy at the support level when stock's down, and it indicates a safe price to sell at the resistance level, or probably a good price to sell and exit your position, but a safe price to sell and enter a bearish position. Everything between is your profit margin. So simply put, you want to buy near levels of support, you want to sell near levels of resistance. It's very important that you trade in the direction of the next biggest trend. If you're a short-term trader, trade in the direction of the intermediate-term trend. If you're an intermediate-term trader, trade in the direction of the long-term trend. That means if the long-term trend is down, like right now we're in a bear market, this is May of 2022 when I'm recording this, the long-term trend is down. A lot of people are having trouble getting their head around that fact and accepting that as fact. But the entry level is to take bearish positions when the market rallies within a long-term downtrend. Your exit is after the market sells off, you profit from that bearish move. Now, simply put, you want to buy near levels of support, you want to sell near levels of resistance, and this is just one simple example of how technical analysis can help guide you through educated decisions in the market. When you complement what you've learned here with other methods of technical analysis, your trading is going to become more technical and much more successful. But here's the biggest takeaway from this. Strong levels of support and resistance are formed by those traders that are adding the most volume to the market, the biggest traders. These are the big institutional traders. And to take that further, the vast majority of institutional buying and selling is done by algorithmic systems that are programmed to automatically buy and sell at those price levels. And since they're programmed to automatically buy and sell, they're pre-programmed, we have a very good idea of where they're going to be buying and selling ahead of time. We know what those computers are programmed to do and what those software programs are programmed to do. Institutional traders won't just let a stock they buy fall through their entry price without a fight. And that's why a support level is actually created, because these institutional traders, they buy stock at $10, it goes up to 12, and then it comes back down to 10. Those same institutions will go in and they'll buy more at 10. In fact, they'll leave a little bit of ammunition. They'll leave a little bit of money on the side. If they're buying at 10, they'll push it up to 11, 12. They'll make sure they don't initiate the entire position yet because they know it's going to come back down, and they want to show the world that's looking at that same chart that this is where we're saying support is. Right? Institutional investors manipulate the market. That's a fact. So knowing that, you know that institutional traders won't just let a stock that they bought fall through their entry price without a fight. And that's why we use terminology like we say demand is in control, because it really is in control. You have institutions that are in control and they're pushing it higher. It's a giant tug of war match between the buyers and the sellers. And the biggest battles are fought at support levels and resistance levels. In other words, it's a really big deal when a stock breaks through either one of those levels. It means one side has won the tug of war match, and the stock will likely continue to run in that same direction for a while. So while support and resistance are easy to identify, don't let that make you think that they're not critically important for timing your entry and your exits from your stock positions. In fact, I'll tell you one thing that goes across all of stock trading, bond trading, any financial market trading, is that people overcomplicate it. And it's actually very easy. And the most potent indicators and rules are the simple ones. So stop overcomplicating this, all right? And also stop worrying about what's in the news. Just study price behavior. It'll always show up in the price before it shows up in the news. That's all I have for you right now. If you want to learn more about technical analysis, tune in to True Market Insiders. Okay, you can actually sign up to True Market Insiders for free. We publish every single day, truemarketinsiders.com. We want to give you all the tools that you need to be a successful trader on your own. So, thank you for watching. My name is Chris Rowe. Can't wait to see you on the next video. Again, please hit that like and subscribe button below. Don't forget, and I'll see you soon.